What's up, Investor Channel? Today we're going to talk about why the IPOs of Uber and Lyft have been, well, a wreck for investors. What's going on, everybody? If you're like me, you've probably used Uber and Lyft to get around. It's a great way to do it, and oftentimes it's a lot cheaper and way more convenient than getting a taxi. So why has the stocks of both these companies have gone down nearly 50% since they both IPO'd within the last year or so? So reason number one is because of something called lockup expiration. So what happens is when a company goes public, oftentimes the employees and certain investors, early investors, aren't allowed to sell their shares for a period of time. Well, that period of time ends up expiring, and what it often does is it creates selling pressure and increased supply of shares onto the market. And if the companies aren't creating more demand, if there's not a lot of buyers of those shares, what often happens is the stocks continue to go down and down. Now, these employees and early investors have every right to sell their shares. And me as a common investor do want the employees and even early investors to be rewarded for bringing the company to the stages where it's at. But one thing you need to be mindful of as a common shareholder is this is going to create more supply, more selling pressure. And if these companies don't have the confidence of Wall Street and other investors, then oftentimes the share price just keeps going down and down and down. Reason number two why these IPOs have kind of failed over the last year is both of these companies became public too late. Now, Uber was founded in 2009 and Lyft was founded in 2012. So they're not particularly old companies, but their phase of growth has actually been accelerated. These companies reach full scale a lot quicker than previous generations of companies. So it might only take 3, 4, 5, 6, 7 years before these companies really reach kind of a grand scale, maybe a market dominant scale. And so I think we saw that happen with Uber and Lyft as they accelerated their growth very quickly through backing, through venture capital and early investors. And so they were allowed to accelerate and acquire a bunch of users and not really care about making money. And while investors have an appetite for that for a while, at some point, especially in the public markets where these companies trade now, a lot of investors are looking for profits, or looking for consistency, or looking for just a path to profitability. And neither Uber or Lyft are really providing that for investors now. I think if Uber and Lyft had become public maybe 3, 4, 5 years ago, their stock price wouldn't have reacted as negatively because investors would still be looking for that hyper growth, that user acquisition, that market dominance. And that's just not happening anymore with Uber and Lyft. They've gotten kicked out of China, essentially. They failed in many other markets. They're facing regulatory pressures here in the United States. They don't have self-driving cars really on the road or really providing a lot of revenue. There's not a lot of other revenue streams really in the works for these companies as well. So I think that has considerably hurt these stock prices, as they could have became public many, many years ago when their growth was still accelerating, and now investors want profits. Reason number three why these stocks of Uber and Lyft continue to go down is they continue to face regulatory pressures here in the United States, especially their biggest markets, California and New York. Those politicians have just been hammering Uber and Lyft. Out here in California, they want to make the employees considered actual employees and not contract workers of the company, which means Uber and Lyft would have to pay payroll taxes and maybe provide health care and other benefits and vacation time for these drivers who Uber and Lyft kind of view as either contract employees or part-time or kind of temporary workers. Out in New York, there's been similar kind of pressures from those state governments, but also kind of the limiting the access and limiting the amount of drivers that can be out on the road at a given time has happened in New York. So the two biggest markets for Uber and Lyft here in the United States have been just hammering these companies. a lot of this regulatory pressure is ongoing and it's not stopping, and it might only get worse. And so I think that has a lot of investors wanting to stay on the sidelines until all that stuff starts clearing up. The fourth reason why I believe these stocks haven't performed well since their IPO is because of competition. Now, I know there's not a ton of competition in terms of ride-sharing apps here in the United States. It's really just Uber and Lyft. But you also still have taxis, you still have buses, you still have the scooters, which I know a lot of these companies are part owners and well. You can just plain old have a bike, or honestly, you can just go buy your own car. So these companies do face a lot of pressure just in the transportation space, but also overseas. These companies were trying to dominate or trying to break into the China market. They were trying to break into India. They were trying to break into all these other countries. And they faced some roadblocks or essentially have waved the white flag in some of those places, particularly China. So the competition has gotten to Uber and Lyft and have not allowed them to grow into this kind of market dominance outside of the United States. And reason number 5, and really the primary reason I believe the Uber and Lyft stocks have performed very poorly since their IPO, is these companies are not profitable. And their pathway to profitability is still several years away. And in Uber's case, is still on an adjusted basis. So it's not even a generally accepted accounting principle profit. It's going to be on an adjusted basis they'll be profitable in 2 years. Uber and Lyft are losing billions and billions and billions of dollars every quarter, not every year, every quarter. These companies are losing the tune of $1 billion or more. And profits are going to be difficult in that environment because Uber and Lyft theoretically have to kind of raise prices or figure out a way they can charge more for their services outside of kind of growing their market share, which I don't think is necessarily going to be an easy thing to do. So if they start raising the price, guess what that's going to do? That's going to allow competition to come in and maybe undercut them on price and only hurt their chances of success. So in my opinion, again, this is my opinion only, I wouldn't touch these stocks for at least another maybe 12 to 24 months. Start to see, what kind of path to profitability they're going to have. What other avenues are they going to develop to make money? I know Uber has Uber Eats and they have this Uber Freight thing going on. But if you dig into the balance sheets, these new initiatives are burning money. So it's unclear when and if Uber and Lyft are going to be profitable. And so I view those stocks as highly speculative. I'm Colin from the Investor Channel. Leave me a comment, hit that like button. I'll be back some other time. Thanks for tuning in.